Topic 4, Stock Valuation. Readings, Chapter 6, Stock Valuation from Corporate Finance Core Principles, Editions 5 and 6. Learning objective number 1, we're going to value stocks using relative value analysis and price multiples. So using price multiples in comparable firms is like valuation in residential real estate. You look for the price of your neighbor's homes, we'll call those the comps, comparing the price per square foot to control for size, then make adjustments for other differences like a finished basement or a new kitchen. So let's look at a price multiple. So the most common price multiple for homes is the price per square foot. That's a price multiple, price per square foot. So say the average price per square foot in a neighborhood is $150 per square foot. And the range is $100, the cheapest for fixer-uppers, and $200 for luxury move-in ready homes. Now, using these price multiples, or also called relative value analysis and comparables, is your goal would be to say find a house with a lower than average price per square foot with better than average kitchen or location or basement or bathrooms or whatever. Another way of thinking about it, or you try to avoid expensive homes, which means a high price per square foot that have inferior characteristics like a bad curb appeal. So what you think about is the price per square foot. That price multiple controls for one factor only, size, and then you have to make these qualitative adjustments for everything else. So how do we use this concept for stocks? For stocks, you might compare Walmart to maybe its closest competitors. Well, the problem with that is we don't really know what the neighborhood for Walmart looks like, but let's just say I think their competitors are Target, Costco, and Amazon. You know, Amazon's a bit different because I'm not sure I compare Walmart to Amazon, but I'll leave it in there. So I'm going to compare Walmart to those three comparable firms, competitors, by comparing the stock price per dollar of earnings, called the PE ratio, price per earnings. To control for profit per share, and then make adjustments for all other factors like growth or quality of management or the risk of the company. So your goal will be to see if Walmart is cheap but has better other characteristics, cheap in the per dollar of earnings. Now the PE ratio, the actual calculation, you'll just take the stock price per share, you know what you see quoted when you Google stock price for Walmart, and so that's stock price per share. And you divide by earnings per share, you know, that is net income per share. And that could either be trailing 12 months, so it would just be the last 12 months for, say, all the firms, or it could be, say, the prior fiscal year, or it could be a forward PE ratio. A forward PE ratio takes the current stock price per share and divides by the 1 year forward EPS estimate. So a lot of these stocks are followed by Wall Street analysts, and the Wall Street analysts will have estimates of what EPS will be next year. So you can either have a trailing 12 months or prior year's PE ratio, or we'll call it a forward PE ratio, where it's the price over next year's earnings forecast, which is usually the one I prefer. You know, it's just forward looking. So let's look at Walmart compared to these competitors. So I have the trailing 12-month PE and the forward PE, and I have it for Walmart, Target, Costco, and Amazon. And this is as of August 2019. And what you see, here's the average PE ratios for those competitors, or the comps. So let's look at the forward PE ratio. Okay, the forward PE ratio, the average for those four firms is 30. So, who is the cheapest stock? You know, the cheapest stock in this neighborhood. Well, it looks like it's going to be Target. So Target's kind of the fixer-upper in this industry group, or this competitor group, and the luxury move-in stock or home is Amazon, selling at $54 per dollar of earnings. Again, the cheapest is Target, selling for $13 per dollar of earnings. And what you see is Walmart is the second cheapest at $22 per dollar of earnings. and in the middle there is Costco. And I have some other characteristics here. Actually, here are the stock prices. Here are the trailing 12 months profits. Here are the number of shares, and that's how I got the trailing 12-month PE ratio. And then I have the forward PE ratio. And then here are just some other characteristics I grabbed here. Here is the last year's revenue growth, the debt to equity ratio, and the beta. These are two measures of risk. We haven't talked about beta yet. We're going to talk about that in a couple lectures. We'll just say it's a measure of the risk of the stock, how volatile the stock is relative to the market. And then the DE ratio is just a measure of how risky the company is, because the more debt you have, the more likely you'll have a failure or bankruptcy. And then I just put one other characteristic of the stock, the payout ratio. Say all else equal, I'd rather have a stock that pays me out profit. Maybe we'll talk about that when we talk about optimal capital structure. So let's talk about kind of revenue growth and risk as kind of two other characteristics of stocks. So let's kind of look at our cheapest stocks, or the cheapest stock, Target. Cheapest stock in the neighborhood, although it has not too much less than average revenue growth, and revenue growth better than Walmart. Now on the DDE and beta, they seem to be a little riskier than Walmart. So it's a little mixed there. It's hard to really compare Target's PE ratio with Walmart, because it has much higher growth, but also a bit higher risk. Now let's look at Amazon. Amazon, again, is the luxury stock, is the most expensive stock in this group using the PE ratio, and you can see why. It has superior growth. However, much higher risk. So that's a tough one too. Let's look at Costco. Costco is priced about the average PE ratio, kind of in the middle there, average PE ratio, but has, well, it looks like according to beta, it's a little riskier. And it's actually about the same risk as the average. And as far as DE ratio, much less risk, and has pretty good growth. Now, Walmart. So let's think about how we'd value Walmart. So Walmart has lower than average PE ratio. It's actually, but it's more expensive than Target, but cheaper than Costco and much cheaper than Amazon, but has the worst growth and about kind of average level risk for the industry. So it's really tough on qualitative measure to tell you that Walmart is really expensive or really cheap compared to this. So it's kind of hard to say. So I'm not sure what to make of Walmart using the PE ratio. One way you can use the PE ratio and price multiples to actually value a stock, come up with a number, is you could come up with an idea that, I think that Walmart deserves the same PE ratio as Costco. So let's look at the trailing 12-month PE ratios. So Costco has about a 33 PE ratio. And what if you determine by your analysis that you think, well, you know what, Walmart has less growth and less risk, so they don't deserve 30. And they certainly don't deserve this valuation here of 54. What if I think Walmart deserves, based on this analysis, a PE ratio of 25 using the trailing 12 months earnings per share? So I can take that PE ratio of what I think it deserves of 25, and Walmart has a earnings per share of about $3. So I could come up and say, you know what, I think Walmart deserves a market price of 75. So that's the one way of doing it, is try to figure out what each company deserves as far as a PE ratio, and then multiply that. And again, we're using trailing 12 months. So I think that Walmart deserves only a 25 PE ratio. They had a 37 PE ratio. Therefore, I think it should only sell for 75 and not 109. So this is the way you can use price multiples, in this case a PE ratio, to control for profitability. All right, notice I didn't try to compare net income when I did my analysis of multiples, because I've already controlled for that, because I'm looking at the PE ratio. All right, if I was just looking at stock price, well, yeah, then I'd start looking at EPS, earnings per share, as a characteristic, but I've controlled for that. Now, there are a lot of different price multiples. There's a multiple of multiples. So here's, again, Walmart, Target, Costco, Amazon. And I got my trailing 12 months PE ratio and forward PE ratio from a different data source. And let's talk about some other multiples are used. Here's a price per sales. So it's the price of the stock, price per share, divided by sales per share. So it's controlling for sales levels per share. You have the price per book. So it's the price of the stock over the book value per share. So that would be, again, assets minus liabilities, your book value of equity. Take that as a share divided by number of shares. So you take the price of the stock over the book value per share. And then here's some other valuation multiples. The enterprise value, we'll define that later, divided by revenue per total revenue, or enterprise value divided by EBITDA. All right, so there's lots of different multiples. And what I circled here is under each multiple, I looked at what is the cheapest. And it looks like on every multiple, besides one, Target is the cheapest. So Walmart is the fixer-upper of the group. And that's not bad, right? Sometimes fixer-uppers are a good deal. Amazon tends to be the most expensive on every one, except one ratio, the PEG ratio. What the PEG ratio is, it's PE ratio. Take the PE ratio and say a company had a PE ratio of 30, and you divide it by the growth rate, and say they're expected to grow by 10%. So what you have is, say, a PEG of 3. Just take the ratio of the PE ratio of the growth rate. And so when you do that, a lot of people, the way we talk about this one is it controls for two factors: profitability per share and growth. And when you look at that, actually Amazon's the cheapest stock. So it's an interesting analysis when you look at PEG ratio. A couple other notes here. A lot of firms have negative earnings per share. You know, they have one-time write-offs, or they just had a bad year or restructuring. So if you have a bad year, what you want to probably do is your PE ratios are going to be negative. So you probably use a forward PE ratio, hoping that next year's forecasted profits are profitable. However, a lot of industries have negative earnings, maybe really new industries that are just kind of emerging. They haven't really gotten profitable yet. In that case, a lot of firms or a lot of valuations will use price as per sales as a ratio, or price per book value, or this enterprise value over EBITDA. Again, we'll talk about more about enterprise value in another soon. So last thing I want to talk about under this topic of relative value and price multiples. All right, price multiples are used to determine relative value. That's why sometimes this is called relative value analysis. Only comparing the price of a stock compared to other stocks. What price multiples like the PE ratio do not tell you is whether or not the entire industry group is overvalued. Maybe all of retail, like Amazon, Target, Costco, Walmart, maybe all of them are grossly overvalued. Relative value doesn't tell me that. Just like maybe some neighborhood, all the homes in that neighborhood are overvalued. All this analysis is telling me is relative to that neighborhood, which one's cheap, which one's expensive. So relative value is not going to tell you whether or not the stock is actually overvalued or undervalued as an investment in absolute terms, whether I'm going to make money. It just tells me, you know, relative to those other stocks, it looks cheap or looks expensive. So in this topic, we talked about using relative value analysis and price multiples to value stocks.